Yeah, ladies and gentlemen, good afternoon. Dear Catherine, it's a great pleasure to welcome you all today to Catherine Schenk's lecture. Catherine Schenk, who is the current visiting professor of financial history at the House of Finance of Goethe University, Frankfurt. I'm not yet officially the director of the House of Finance. This will become effective by July 1st, which means next Friday. But for me, it's a particular pleasure to introduce this lecture by Catherine today. So first of all, I would like to thank Catherine for kindly accepting our invitation to come to Frankfurt, and not least because she had to put off her stay at Frankfurt twice due to the pandemic, 2020 and 2021, until we could finally hold face-to-face events again. So very, very good to have you here. Catherine Schenk is Canadian-born. The name signals that there should be some German roots. Also, we discussed it last night, also to the Frankfurt region somewhere. But today, Catherine is professor at the University of Oxford and has had teaching and research assignments in both the West and the Far East. She's a much sought-after advisor to international institutions, including the Bank for International Settlements, where she delivered the Per Jacobsen Lecture in 2020. She was co-author, this should be mentioned here in Frankfurt, co-author of the Festschrift for Deutsche Bank that came out in 2020 under the title The Global Hausbank, or Hausbank 1870 to 2020. And her most recent book is titled Remembering and Learning from Financial Crises. I would also like to mention that Catherine is holder of a very prestigious ERC Advanced Grant for research on global correspondent banking. I think we could see the GLOCO sign on the slides there. So the global correspondent banking since 1870, a study of international banking and payment networks, and I think we will hear about this also in her lecture. Catherine will be here in the House of Finance until mid-July, encouraging research and the exchange of ideas over the long term, as well as highlighting the historical perspectives of today's challenges. From her temporary academic home at Goethe University, the House of Finance, she will be providing a number of new impulses, including today and tomorrow, a workshop for early career scholars that will focus on topics such as the stability of banking and financial markets, monetary policy, and the development of banking networks and the technological foundations. And I had the opportunity to follow a little bit the workshop this morning, and from what I heard and saw, I think this was really a very interesting and inspiring experience. I would also like to thank Bankhaus Metzler and the Friedrich Flick Förderstiftung for their generous endowment for this visiting professorship in financial history. The endowment, which was established in 2014, enables us here at Frankfurt University to invite internationally renowned researchers in order to further expand our financial history activities here in Frankfurt, a leading center of research in finance and a leading financial center. Catherine is the 6th visiting professor of financial history in this program, following among others, Barry Eichengreen, who joined Goethe University in 2019, and Harold James in 2018. And we can already announce that there will be a new nomination coming up for next year. Today's lecture by Catherine, a joint event by the Leibniz Institute for Financial Research, SAFE, the House of Finance of Goethe University, and also the Institute of Banking and Financial History, a very good cooperation partner within our network of institutions at the House of Finance, will focus on the evolution of the global payments system, the associated risks to financial stability, and the influence of technological change. Thank you very much again, Catherine, for coming to Frankfurt and for accepting to give this lecture today. The floor is yours. Thank you very much.
Thank you very much for that very gracious introduction. I'm most pleased to be here at Goethe University, House of Finance, finally after 2 years delayed, and to be able to meet with people in person, to be teaching some really interesting and interested students about the history of money and banking, and indeed organizing an early career researchers and bringing people together physically to have that kind of creative experience again. I'd like particularly to thank also SAFE and the EBF and the House of Finance, Hannah Flotto-Degener and her team, who've been absolutely marvelous in the arrangements and making sure everything goes smoothly. And to Bankhaus Metzler, of course, it's a really important and I think visionary idea to make sure that historical perspectives, or the long run, if you like, is embedded in our understanding of the evolution of financial markets and banking markets, particularly at this really critical and crucial moment, I think, in the global system. So thank you very much. As you heard, this is research is the beginning part of a large 5-year project that we've only just begun on global correspondent banking, where we're looking to uncover the plumbing of the global payment system, a rather neglected aspect until very recently of globalization. And an important point, I think, of risk and vulnerability. Okay, so as I say, it is kind of the fundamental plumbing of globalization, and yet we don't know that much about it. It's a bit dull, it's a bit boring. People were much more interested in investment banking and corporate finance and other sorts of things. But underpinning the first globalization in the late 19th century and the second globalization in the 1990s and through the 2000s has been the ability to move money from one country, from one person, through a payment system across space and time. And this is a really important kind of technology that emerged in the 19th century that persists today. So what are we looking for in a global payment system? There's a series of desiderata. You want it to be relatively inexpensive. You want it to be secure. You have to trust it. You want it to be stable, that it's not going to collapse and leave you out of pocket. There's issues and tensions about transparency, that it's good to be transparent and to know what is going on, but there's also a sense in which some of the participants would like to remain private or secret, and so there's a tension there about transparency. But certainly in terms of moving money around the world, we need to know where it's going. There has to be some kind of element of supervision. And since 2001, the pressures, particularly against money laundering, against the finance of terrorism, and the kind of know your customer elements of the global payment system have gained in traction. A third aspect I wanted to emphasize at the start is about the importance of network externalities, that you don't want to necessarily be the only one on your payment system. There are network externalities to people standardizing, harmonizing, using a kind of a multilateral platform that increases the ease and the scope and reduces the cost of those transactions. Nevertheless, in very recent years, recent for a historian, in the last 10 or 15 years, we've seen a contraction, it seems, in the global correspondent banking system that underpins the plumbing of globalization, both in terms of geography and currencies, and I'll discuss that a little bit. We're aware that there are points of fragility in this very complex network, that there's settlement risk, that you might be sending your money, it might not get received. You may be expecting money in that doesn't come. So there's settlement risk. There's the fragmentation of liquidity. There's issues of interoperability if you have competition amongst systems. There's hacking. There's fraud. So there's a lot of areas of vulnerability in this system that are really important. Most recently, the SWIFT system and the role of sanctions as part of a geopolitical tool have been in the news, particularly around Russia, but even previously we've seen that with Iran in 2012 to 2016 and earlier in 1970s. We also see a lot of innovation and proliferation in the kinds of technologies that are possible out there for the global payments or to send money across borders, including digital currencies, distributed ledger technology, decentralized finance. And this has been growing really quickly, and I'll refer to it a little bit at the end. And for these reasons, the global payment system since 2020 has become a much more important part of the agenda of the FSB, of the G20, of the BIS, Bank for International Settlements, and their Committee on Payments and Monetary Infrastructures. And they're developing it as a priority to increase the robustness of this plumbing, underlying plumbing, in order to support the continuation of globalization. Okay, so what I'm going to do is introduce a little bit about the long-term evolution of global payments technologies, and really draw out for you, perhaps as a historian would, the continuities that are apparent in this system over a long period. So it seems very highly technical, very whiz-bang kind of stuff at the moment, but the underlying technologies are very familiar to us from the 19th century. I'm going to look specifically at two aspects of new systems that were introduced, both in the private sector, and that's the clearinghouse interbank payment system and SWIFT, which we know so much about as the messaging system. And particularly, I'm interested in why are these private sector initiatives rather than public sector initiatives, since there's clearly a public interest in the stability of the global payment system. And that's the kind of question that a historian can go back into the documentation, look at the origins of these institutions, and look at underneath the hood, if you like, at the debates that were around at the time. And then I'll refer a bit more speculatively, I guess, to maybe the future of global payments and be a little bit pessimistic about crypto, a little bit more optimistic maybe about blockchain, stable coins, and CBDC. Okay, so first of all, in terms of the evolution of structures, we have instruments and we have platforms. So the instrument that emerged in the 19th century was the Bill of Exchange, and it was a very important, call it a technology. It was a standardized format, often associated with a letter of credit, and it underpinned movements of funds over very long distances through the manipulation of nostro and vostro accounts. So again, it's about you debit your bank account in Colombia and you credit the bank account in the USA, whatever. And this is an 1870 Bill of Exchange, and it's kind of messy. And I think that messiness is important to understand. It all has to be kind of handwritten. You can see that it's been through a lot of iterations. You've got scribbles over it from one side to the other. It's an 1870 Bill of Exchange, as I say. And it's drawn by a company in Shanghai against letters of credit and bills of lading, so it's a trade bill. It's got an acceptor or a guarantor in a bank in Lyon in France, and it's payable in London, so it's already, this single piece of paper has a little network embedded in it, if you like a chip. It's got 8 months maturity, and then it will have traveled across the world from Shanghai to London, and might have been discounted, indeed, several times on its way. It would have been posted. The information on it would have been telegraphed, and the telegraph would have been received, and account ledgers in the banks of the recipient and the payee would be adjusted. So it's a very kind of fundamental technology. It's got a lot of information embedded in it. It's quite complex, and it's not a linear sort of story. There's a lot of simultaneous activity that's embedded in this piece of paper. In terms of platforms, of course, everything used to be mailed, so we can still remember some of that. We then moved on to telegraph, which was a really important technology through telegraph cables. The movement from telegraph, which required somebody to be waiting for the message to come through, often in code and then decoded, to telex, which had automatic switching involved in it, but still used the same kind of lines, to computers. And initially, for those of us who can remember, there was the huge, huge computer, and then everybody else had just sort of terminals hanging off it. To much more digital network, which is kind of less of a hub and spoke and more of a network. And then most recently to distributed ledgers, which is the newest kind of technology. In each case, there's these issues about transparency. So information is coded. Sometimes that's for privacy. Sometimes it's to lower cost. And sometimes it complicates matters. It makes it more expensive. It all has to do about speed. And speed is of the essence in global payments because time is risk. So all the time between sending your money and get credited somewhere is a risk in the system. And they all have codes and this sort of thing. So these sorts of aspects of it are quite enduring. The real danger, as I say, is in settlement and netting out these transactions. And there's time is a risk and your counterparty is a risk. So the faster you can get something through before your counterparty risk increases is important. And we'll see that it's only really in the late 1980s that we link into central bank money through real-time gross settlement as sort of a clearing through the domestic central bank money. Nevertheless, this underlying fundamental structure of correspondent banking, which I've been speaking of in terms of the adjustment of an account in one country in response to a message that comes from an account in another country, has endured. So this is how the Federal Reserve describes the correspondent banking model. And you see how somebody trying to pay money, they go to their bank and ask for that to be done. It can go through their domestic payment system to a bank that has a correspondent relationship in the country of the payee. There's fees charged all along the way here. The correspondent bank makes contact with the correspondent bank to which it has a particular contractual relationship often. The money then goes through the payment system in the payee's bank and then ultimately into her or his bank account. So you can see that in this long journey, it looks kind of like a bill of exchange in a sense that it's kind of moving along. Bill of exchange had more of an element of credit than the correspondent banking system. But you can see that there's a lot of steps along the way, and this increases the risk and the cost and the time. Just to show how gets kind of more complicated, this is the second stage, because often you don't have a direct relationship. So a payment can go through several banks before it enters the payment system of your receiving party. And it might go directly through the banking, or it might go directly through messages amongst banks, or it might go through the domestic payment system. So this is from the CPMI, and it's trying to explain again diagrammatically how these things happen. This is a complex slide, and I'm using it to demonstrate the complexity of this, of this process. Okay, so what was the underlying technologies here? It was the telegraph, as I say, and the ability to telegraph the information off that bill of exchange in order to get movement of the funds between, or movement in the Vostro Nostro accounts of the banks. And this just shows you the major telegraph routes by 1891. So already by 1891, you have transatlantic, you have a kind of a whole global network or system across the Atlantic, across the Pacific, through Africa, through South America, through Asia, across Russia. And so it's already a global network, and it's fundamental to that first globalization of the late 19th century. By 1901, you've got a lot of private companies involved, and this is one, and it shows the multiple cables that were crossing the Atlantic in particular, but also multiple cables linking the world very intensely for these flows of information. I'd like to just juxtapose that against the submarine cables that carry our internet traffic now. So again, I'm just not drawing a complete parallel, but those fundamental structures that were founded in the 19th century are still the basis of our internet traffic now. Almost all internet traffic goes through submarine cables. So I think this is a really important and enduring aspect. I'm kind of fascinated by telegraph cables the more I hear about them. I think the imagination to think that you could do this and just unwind something along the seabed in the mid to late 19th century is an astonishing kind of leap of faith in technology. Okay, one of the themes I wanted to draw out is public versus private interest. So the cross-border payment system is clearly a public good, but it carries a public cost in case of failure. So if the whole thing imploded, central banks and governments would have to be intervening, not maybe as a complete backstop to the whole payment system, but certainly rescuing and reconstructing the system as it is. But it's often private sector initiatives that are driving the system forward. Why is that? It doesn't need to be that way. It could have been a cooperative interstate organization, but it wasn't. And maybe that has to do with the origins of the first globalization. The origins of global payments was amongst private sector banks in the 19th century. And I showed you that bill of exchange and that technology, and that involves trust between institutions, and it functioned extremely well. So why would the state intervene, particularly in the 19th century, when the role of the state and its responsibilities for economic welfare are so much lower than they are today? Nevertheless, you do have the post and the telegraph and telephony coming into and out of state-owned ownership. So there's a recognition that the infrastructure, the technology infrastructure, is a public good, and so there is some public involvement there. And indeed, even in the 19th century, the Bank of England was a major discounter of bills of exchange, of these bills that I just showed you. So in times of liquidity problems in the global payment system, you could always go to the Bank of England, and they would give you money in exchange for those trade bills, or indeed finance bills. They weren't so worried about one or the other. So again, there's sort of a lender of last resort element in the providing the liquidity to the global payment system. And Acamanati and Ugolini have really shown that it's a lot of international bills that are being discounted at the Bank of England at the start of the 20th century. But I wanted to look at these two major private sector initiatives, one in settlement and one in messaging. They're both still with us today. And look at the origins of their private sector dominance, and they're obviously still in private ownership today. Part of it has to do with the role of technology and the way that the state and public entities are rather behind the curve in technological change often. Even in the early 1970s, computer technology was experimental, it was expensive, there weren't that many people that understood it very well, and so you had to remunerate them and reward them for their knowledge, so they were expensive. There's also a sense of ideology, even in the early 1970s, that this is the business of banks, and it should be left to banks. And part of that is an ideological idea, but maybe a part of it is also that if you got involved in supplying these sorts of structures and these systems, that there'd then be some responsibility if it goes wrong more directly. Okay, so first looking at the clearinghouse interbank payment system, we need to imagine ourselves back into 1968 in New York. You have a New York clearinghouse which clears almost all the US dollar cross-border payments through its banks, through its correspondent banks. And those correspondent banks in New York, all the big commercial banks, have correspondents and respondents scattered around the world, everybody who wants to be transacting in dollars and settling in the US in New York, settles in New York. Each of these requirements, you get your message in from Telegraph or Telex, and somebody has to write it down, and then somebody types out a check to transfer the money to the other correspondent bank. Then somebody has to check the check, because you could have got the spelling wrong, you could have missed out a zero, and that would be kind of disastrous. And then you have to take that check physically by bicycle down to near Wall Street, where the clearinghouse is, the New York clearinghouse, and present that check for clearing. And there were several clearings every day in New York of these checks that were the transfer of money. So, but most checks you had to they waited until the end of the day in the hope that they'd be getting the money into their accounts before they signed it back out again. So you can imagine this kind of works okay when there aren't that many payments. And in the 1950s, when international banking was just kind of getting going again, maybe it worked okay. But by the late 1960s, you have the internationalization, particularly of American banks, and they're branching around the world. There's the rise of the offshore Eurodollar market, so the number of transactions and the liquidity in the dollar market is suddenly huge. And so you can think of a real kind of road jam traffic jam of these cyclists cycling down with their big knapsacks full of checks to get cleared. And the difficulties, the risk of something going wrong, the pressure on people to be writing these checks and having a paper system became extremely intense. So here we have a quote from the Reserve Bank of New York archives that the sort of within 2 years, you used to have people in your payments section that had been with the bank for 22 years, and they were all just kind of happily writing out their checks and sending them off to the clearinghouse. And 2 years later, you had to take in so many staff that the average was 8 months that they'd been with the bank. So the amount of business really increased, and the cost of that business increased. It's a time when there is a technological innovation available. They were waiting to use computerization to apply it to the domestic clearing system, but they thought, well, actually, the international clearing system is more urgent. And so they developed a system within the clearinghouse members, that you could enter your information not written on a paper check that had to go down to Wall Street, but you could enter it from the comfort of a huge computer office into a computer terminal, and it would all kind of be sent through in real time, and then finally the computer would net it out at the end of the day. So you then had 30 minutes to figure out what your position was vis-a-vis the whole system, and then if you were in deficit or surplus, the final payment was through accounts at the Reserve Bank of New York. So at the start, it's limited to members of the New York Clearing House, and so they're really generating quite a lot of rents through barriers to entry here, and it enhances the services that they're able to provide and charge for. And then it's widened up slightly to associate members and EDGAC subsidiaries. So as I said, this is still with us. So this is the data from the CHIPS website. And this is the average daily number of transactions that is going through the system. And you can see it goes up, and it's marvelous, and it's off to the stars, if you like, this kind of graph. This is the amount of transactions. This doesn't look quite like it's going off to the stars. There's a curve there. Certainly there's a rapid increase. But you see a check after 1997 with the Asian financial crisis and the other emerging market crisis. You see a big surge in 2007-8 as there's a lot of payments going through in the maelstrom of the global financial crisis. And then the nominal amount of transactions has been relatively steady. In real and nominal, you can see that there's quite a big difference. Okay, so let's go back to its origins. And when it started, there's a lot of time lags in the system. So your foreign exchange was immediately available. You paid it out, but the matching dollars coming in weren't available till the next day because it was going through clearinghouse funds. And this delay meant that things that were kind of happening on a Friday didn't happen until a Monday. And there's quite an incentive to allow that to happen because you can do some other stuff with that money over the weekend and make a bit of a margin on it. There's quite a lot of what they call daylight overdrafts. Okay, so there's a surge before the final settlement in the amount of funds that's sort of outstanding against each bank. So in a sense, there's sort of a daily credit risk that's going through the system every day. And of course, there's time, and then there's time change, particularly between London and New York and Western Europe, where the main financial centers were. So New York clearing in New York time isn't completed before the European banks close. So again, this is another quotation from the Reserve Bank of New York, and I think it's really a crucial one to be understanding banking generally. It's a business in which trust and confidence is essential. You had to believe that your counterparty was going to give you the funds that they promised to give you when you sent out your foreign exchange. In the end, soon after it gets going, there's a huge shock to the whole system. And this is the Herstatt Bank collapse, about which I expect everybody here knows everything. There's fraud, there's insolvency, there's all kinds of exciting things happen. It exposes what's called the Herstatt risk still now. There's a sharp fall in turnover, and a sharp and sustained fall in the average size of the transaction. So again, this is the Clearinghouse International Payments data, and this is the average size of a payment. And I think this speaks a little bit to the element of trust in the system. How much would you kind of put through in one lot? So you can see that it's expanding very, very quickly in nominal terms to 1973, but with the Herstatt crisis, the trust gets sucked right out of the system. And you see a really rapid decline in the nominal value of the average size of payment. And indeed, even in nominal terms, and remember the 1970s is the great time of inflation. So this is nominal. It's not reachieved until 1986. So I think there's a fundamental problem in the chips during this period, if you wanted to say that, or maybe the enthusiasm and exuberance of those first years met its check most appropriately. But the Herstatt crisis, I think, had a really lasting and important impact on the global payment system that isn't so well understood. It was understood, however, by the participants. And again, going into the archives, you can see the discussions between those at the Reserve Bank of New York, at the Fed, and those in the clearinghouse. And the clearinghouse members are pushed very hard to try to reduce the risk in the system, to have some kind of minimum capital put up for the members so they might be more resilient, to try to speed up the settlement in some way, in other sorts of ways. At the same time, however, while the Fed is trying to reinforce and push somewhat reluctant clearinghouse members to reform, there's a lot of political pressure in Congress because the Fed is not very popular amongst politicians in this time. This is the time of the Great Inflation, and Arthur Burns as governor of the Federal Reserve. And there's a lot of political pressure against the domestic state-owned payment system called FedWire, and that they argue very strongly that they should not be competing, the state should not be competing in the provision of payment systems with the private sector. And so this is in 1977, and they force FedWire to start charging so that it's not competing with chips. Now, the real public sector addition to the global payment system, real-time gross settlement, and the way to you can plug the cross-border into your domestic gross settlement takes another 10 years. And so this is just an image. I think people kind of forget how long it took to get going. So you had the US had FedWire, and then the next one was Denmark, and then Netherlands by 1985, West Germany and Switzerland in 1989, the UK not until 1996, and so it goes. But this is a real interesting area for research, I think, if anybody's interested in looking for a research project. The other thing I'm looking at is the multilateral oversight of this system. And again, it's quite slow. So you have the group of experts on payment systems at the Bank for International Settlements starting in 1980. But the records of that is really, it's all about coming every 2 months or whatever and saying, what's going on in your domestic system? And they all go, oh, well, our domestic system looks like this. And then they share what their domestic system looks like. There's really not a lot of coordination or discussion or willingness really to discuss the cross-border problems. That comes a little bit later, after the Lamfalussy report with the Committee on Payment and Settlement Systems, which is the precursor to the Committee on Payments and Market Infrastructures, which is so avidly trying to catch up now to be looking at the global payment system. You do have other kinds of initiatives other than CHIPS. You have CHAPS, for example, in London, which does domestic and international settlement. It's interesting that the operations were taken over by the Bank of England in 2017, so-called to enhance systemic stability. Okay, so another interesting area of research to be done there. Okay, so the second institution I wanted to look at was SWIFT, which is the Society for Worldwide Interbank Financial Telecommunications and has been much in the news over the last 6 months or so. This is not settlement, this is just payments, messages. Okay, so it's sort of about common codes. And it began to be discussed in 1969, and really only goes operational from 1977 onwards. So that's a really long time, and it's a time of a lot of innovation and a time of the global inflation and the oil price surge, and all the dramatic things that happened in the early 1970s. It's prompted by belief in economic and monetary union is just around the corner, possibly, with the Hague Summit in 1969 and the Werner Report that followed. So banks in Europe and elsewhere are really getting ready to respond to a single market in Europe through consortia and banking groups. Driven also by ICT innovation. The Americans seem to have really nice, bespoke internal payment systems for themselves, and so there's a little bit of a threat that they might take over the global payment system. And it's also an era where everybody's trying to harmonize everything. There is sort of a sense of a harmonization of standards in business. So the ISO initiatives are really getting going then, and UNCTAD at the United Nations. I think it's interesting that when they founded it with their original members in 1973, both Herstatt Bank and Franklin National Bank, another very famous bank that failed in 1974 in the USA, were members, or founding members of SWIFT. Anyway, again, I like to encourage you to think about the public versus the private sector. And again, this is based on archival work, this time at the Bank for International Settlements, which started, and the bank BIS staff said, maybe we should think about this computing lark. So they started a meeting group. They weren't allowed to call it a committee in 1969 to bring the technical experts from all the G10 central banks together. And they start worrying about that, and then they're kind of worrying also about what's going on with this SWIFT thing. It was called something else at the start. And how should we be involved in this? And is this something we should be doing maybe instead of somebody else in the private sector? So it is debated and contested about the role of the public versus private sector, even as it's being developed during the early 1970s. The BIS is getting ready to move into its wonderful big tower building in 1975, and it's designing its computer system at this time. And it's asking the central banks also, would you like us maybe, we could use our computer and we could have a multilateral clearing and settlement system within the BIS itself. Okay, so these ideas are resurfacing now. They try to get involved with the schemes that are being developed between 1969 and 1977, and they're really pushed back, and they allow themselves to be pushed back, which I think is really important. Okay, and this is kind of what the system looked like in 1978. It's sort of a consolidator. Each nation would have sort of a sets of computers that would collect the messages and then pass them to Brussels and maybe to Amsterdam, and then they'd be kind of sent back out to the other centers. It's a really rocky start. And I'm struck looking at the archival records of the British Bankers Association, also the Bank of England, also the Bank for International Settlements. People kind of hate this system. And maybe that's why it took so long to get going. There's a lot of technical delays. So they get the same computer company, this company Burroughs, as they had at CHIPS. It's very expensive, and their estimates keep going up and up and up, and their requirements keep changing. It's a very expensive system. So you have to pay an upfront fee, but then you have to buy your equipment, and then you have to pay the joining fee, but also a sort of an ongoing fee. There's these conferences where you're supposed to go and train your staff about how to do it, the SIBOs, which is still around at the moment. I should say the British Bankers Association in the 1970s, they thought, oh my God, another one of these really expensive conferences that we're supposed to send our staff to. This seems a bit much. The whole rule book and the old rule books are all in the files here as they evolve, are kind of evolving, as I say. So there's a lot of some uncertainty about when is final settlement and what code should we be using for this, and do we need to kind of, is it final when they send the message or when they receive it, and all these kinds of issues. I think it's not too well thought out in advance. They thought they'd be using the messages more for account reconciliation, which feels a little bit more like settlement, and it turns out that they use them more for payments messages. The governance of it is interesting. It's a non-profit organization based in Brussels under their set of cooperative corporate legislation. The central banks and the BIS asked to join in 1970-71. The governing body as it's planning for what the system is going to look like. And the banks go back and think about them amongst themselves, and then they go back and they say, no, nope, sorry, you're not allowed. So you're not allowed to have any, there will be no central banks on the governing body. If you're a central bank, you could get involved through your national committees who are feeding ideas into the governing body that's designing the system. But this prompted some problems for some jurisdictions. The Federal Reserve, for example, had a difficult relationship with the American Bankers Association, so they found it difficult to join something chaired by the American Bankers Association. So there's kind of problems there. They fought very hard to try to get the BIS, at least, to be able to sit on the governing board and feed in, because it wasn't a central bank. But that is also rebuffed quite strongly. So in a sense, maybe they came too late, but they're trying to get in before the thing is fully designed, and they take no for an answer, which I think is interesting. They do join rather gradually. And this is the distribution of shares in SWIFT by 1979, and you can see it's predominantly a European kind of story. And the Americans are a bit on the sideline. They're using SWIFT to kind of plug into their domestic system. And Germany is the largest player, which is nice for this company. And it is very successful. So once it gets going, there's a few niggling problems, but their daily traffic volume does increase very quickly. And again, SWIFT is still with us. So here we have the SWIFT connections, the number of countries where there are connections, and the number of users. So this isn't the number of members of SWIFT, it's the number of users. So it's the members and the associated firms. And you can see that there was kind of a dramatic rise, a bit slow, then it speeds up in the early 1990s before leveling off. And part of the change has to do with how they let other kinds of non-bank entities in. So after quite a lot of lobbying in 1987, securities firms, other national clearers are allowed to be members. And from 1992 onward, fund managers are allowed to use the messaging system and become members. So this boosts the number of participants, and also you can see the number of countries. Great, a lovely success story, but not really. So what's happened most recently and has attracted the attention of some policymakers is there seems to be something happening in this system. So SWIFT, remember, is a messaging system. So it's sending messages from one correspondent bank to another correspondent bank in order to have them adjust their accounts. So we're still in the correspondent bank underlying technology. So this data is showing you the value and the volume of those messages between banks. And you can see that the blue line is the value, which is kind of flat until 2017 and then has been rising. The volume has been sort of rising, so the average size has been falling a little bit. But you also see that gray line, which is the number of active correspondents in the data that they've shared with the Bank for International Settlements. So you can see that there's some kind of retreat or some kind of contraction in the number of these bilateral relationships that's being recorded. And it's not even across the world. So this is, again, we only have the data back to 2011, but we'll try to get it a little bit earlier. So this is an index, so you're starting with everybody how they were in 2011. And you can see that the decline is uneven according to region. So you have the largest fall in the Americans, except for North America, so particularly Central and South America, the Caribbean, and then in Africa. So there's a lot of explanations for this. We can see it as maybe there's the intensity of anti-money laundering or counterterrorism. The cost of knowing your customer makes it not really worthwhile to have so many, and particularly not so many in certain jurisdictions where it's more difficult to get that information. It might be that there have been mergers and acquisitions because you're just seeing the number of those connections. So that could be driving some of the change. But there's a fear that there's an element of financial exclusion involved in this, and that some types of banks, some types of regions are being more excluded out of the global payment system that is dominant, this SWIFT messaging system, that might introduce some more risks from this sort of outlying fringe. I wanted to bring in China and Russia just to see how they've been doing and what they've been doing. And again, this is just since 2012 to 2020. And you can see that already from 2012 onward, Russia, the number of banks in Russia that were members of SWIFT was declining. The number of banks in China is increasing slightly. But in terms of total participants, you get a really kind of dramatic change there, I think, that the number of participants in Russia was declining very sharply, while the number of participants in China, did I say that right, in China, was increasing quickly. And I think it's interesting, sort of in the wake of the sanctions and the exclusion of most Russian banks from the SWIFT system in 2022. As I say, however, we're still with this system, this kind of complicated nostro-vostro kind of an account. So I think that's an important element. And it's not a very efficient kind of system. Remember, I said time is risk in this network. So again, this is from Bank for International Settlements, and it's for using data from October and September 2020. So it's not historical, I apologize. But it shows the range of processing time for a beneficiary in each of these countries. And you can see if you're in Europe, 5 minutes. If you're in the USA or Canada, 12 minutes. You can kind of live with that, maybe. The world isn't going to fall apart in 12 minutes, we hope. But if you get down to in Northern Africa or in South and Central Asia, 22 hours and 45 minutes. So this is all correlated with various indicators of GDP and other sorts of things, but you can see that the system is clumsy in a lot of places. And 22 hours and 45 minutes, that's a lot of risk time. And so the risk in the global payment system is not evenly distributed. I wanted just to bring in the China interbank payment system because that's been in the news also. This is a system that settles renminbi. It's really small compared to chips. It mostly uses the SWIFT messaging system still. So it's not an alternative yet in that sense. And we need to remember, while the renminbi and China are really exciting and dramatic places of change, renminbi in the last reckoning was less than 1.5% of SWIFT messages by value when you exclude the intra-Eurozone. And this is its geographic reach. So it is increasing its number of direct participants from 47 to 76 over the past year, and its indirect participants by even more. But they tend to be Chinese banks and subsidiaries of Chinese banks. And we think that Stanchart is probably one of the first foreign banks to become a direct member. So it's still kind of limited. Okay, so what do we learn from this evolution story? So evolution is a metaphor. And so I'm kind of pressing that metaphor a little bit and saying it's not actually a Darwinian survival of the fittest necessarily. There's a lot of inertia. There's a lot of barriers to entry, partly because of the private sector ownership and the desire to reap rents out of the system. There's entrenched interests of incumbents. And then there's sort of a tension between wanting to control and own and have a barrier to entry, but still get the network externalities that are the beneficiary element of having a payment system. I'd argue, and it's going to take more research to make this convincing to you maybe, that it's not inevitable that cross-payment systems were dominated by the private sector. And it's not inevitable that messaging was in the private sector, that there were initiatives, it was contested, and that decisions were made to have it be the way it is. There's quite a lot of maybe public sector benign neglect until the real-time gross settlement in the 1980s. And I've explained that, well, maybe payments is the business of banking, and it was sort of entrenched in that original technology I showed you of the bill of exchange. But also the public sector tends to be behind the curve on IT skills, particularly in central banks, maybe in other areas of the public sector. And there are international coordination problems, similar to the international coordination problems in the Basel Committee and elsewhere, which is about who's responsible for what, not wanting to necessarily share your information, and sort of conflicts between the architecture of national systems. So the takeaway here is that the correspondent banking technology then persists for this 150 years, despite the fact we see these huge changes in platforms and other kinds of technologies. There's still this kind of fundamental correspondent banking system with all its faults and its inefficiencies that persists. Sending coded messages, having interlinked private ledgers, charging fees, using your correspondent contracts and relationships for cross-selling and other sorts of things is a very persistent characteristic. Okay, but the world's about to change, right? We've got digital currencies and crypto, and it's all really exciting. And we aren't going to need these banks anymore, this TradFi, as it's known. And digital currencies, we need to remember, are not money. So they're not a store of value. And we know that particularly now. Just these graphs that I took off the web for Tether stablecoin has fell well below $1 in May 2022, and we know Bitcoin's lost 2/3 of its value in the last little while. It's not really a unit of account. There's a proliferation of crypto, and they're all priced in US dollars or in another stablecoin. They don't kind of see the value in themselves. And there has been a rise of stablecoins, which are a bridge to central bank money, okay, or cash, like you might have. But only really if they're collateralized. And we saw with the Terra Luna debacle what happens when they were trying to have an algorithmically stabilized stablecoin, and then the algorithm died, and that was the end of that, and everybody lost their money. So the stablest of stablecoins would be a stablecoin that is completely collateralized with US dollars, if that's the value at which it's pegged. It's not an investment vehicle, so you can think of Celsius as kind of a way for people to try to get returns off their cryptocurrencies, which collapsed most recently in the last few weeks. It doesn't really have the network effects of money, that kind of acceptance across a large group of people. There's been a proliferation. They figure there's probably about 10,000 cryptocurrencies out there. You can exchange them and stuff, but it's a bit clunky. And there's quite a lot of concentration. So it's supposed to be decentralized finance, but in fact, there's quite a lot of concentration in the mining and in the validation and in the nature of the blockchains that are being used. Again, this is from the most recent economic report from the Bank for International Settlements, showing that when there's a lot of congestion, when there's a lot of traffic, when there's a lot of business going on in the blockchains, the costs and the fees for validating your transfer increase really, really sharply. So there's an interest amongst the validators to have a lot of congestion in the system in order to generate fees for themselves. And you can also see the kind of beginnings of fragmentation away from the Ethereum platform, blockchain platform, and the red wedge is Terra, which then collapsed most recently. But there's quite a kind of a concentration there. Okay, so it's not money, but could it be a means of exchange? And the most promising area for this is probably stablecoins, although I showed you that Tether is supposed to be stable and doesn't look that stable. It's relatively stable compared to Bitcoin, but not compared to the US dollar necessarily. And the CFTC fined them for false advertising for saying that they were fully backed by US dollars. But that would kind of enhance the speed, reduce the cost, and increase transparency at some level through distributed ledger technology, where everybody's looking at the ledgers all at once. But they borrow their credibility, these stable coins, from central bank money. So ultimately, it's their value in central bank money, your ability to get back out into central bank money that is important. A couple of new initiatives that are just being talked about now. There's the Central Bank of Brazil. Brazil is putting together PIX, which is sort of a retail central bank initiative, domestic initiative, and they're looking to replace debit cards and credit cards and bypass the high fees that are associated with those for retail customers. They got a lot of pushback from their commercial banks, as you can imagine, but they promised them that volume would go up and they wouldn't lose out, and indeed that has been the case. So there's something going on there in innovation, in the innovation space. Perhaps more widely known as the central bank digital currency experiments, and they've been kind of worrying about this for quite several years. I was kind of not terribly convinced by it at the start. It seemed to be like central banks just trying to make sure they kept their monopoly on the issue of money, and wasn't sure what they were going to be doing with these digital currencies. But the planning has kind of evolved, and there's experiments now with using central bank digital currencies across borders and for cross-border payments that have been going on since 2019. But again, there's international coordination problems here about governing these systems, about the harmonization, about supervision, about if you're supervising, are then you're responsible for a backstop, and indeed about privacy. Is the central bank then going to know every transaction that you make because your name is associated with your digital currency, or are you going to have a code and then you're kind of in another realm or another layer of challenges? Anyway, so there is a future out there, and it may be bright, but it's going to take a while to gain hold. Okay, I've just come to the conclusions now. Almost out of time. I'm over time, I suspect. And just wanted to really emphasize the importance of understanding this underlying plumbing of the globalization, particularly in this highly financialized world that we're living in now. And the importance of this kind of bread and butter type of business that banks have been engaged in when all the interest has been attracted by their changing structures and their mergers and their universal banking versus other banking, and that kind of movement into investment banking that we saw in the late 20th century. I think an interesting approach to it is to think about public versus private interests. And the public, we've heard a little bit about this today, the public doesn't know very much about these things and doesn't think about the underlying payment system. But there is a public interest in a stable, effective, cost-efficient system of cross-border payments. There's tensions about transparency versus wanting to have rents, so permissionless entry, and versus wanting to kind of control what's happening. There is some common interest in harmonized standards, but they're hard to achieve, again, because some people are going to benefit from not having harmonization. There's a common interest in network externalities, because that makes everything work nicer. But again, there's tensions about that in terms of how you extract rents. And there's this persistence of this kind of awkward correspondent banking framework. Although it has evolved, it's still kind of awkward. We're now entering a very challenging period for geopolitics, and we're all keenly aware of this, I think. And there's risks to the global payment system and the integration of global payments that is there. The government sanctions on banks and central banks, and there was quite a lot of talk about the SIPs or the Russian payment system, and somehow you might get a fragmentation of messaging. And there's kind of a proliferation of systems where having a system, a national system of cross-border payments is part of the exercise of global influence. And finally, I spoke a little bit and speculatively about digital currencies and blockchain. And if all this kind of happens, that's kind of maybe the end of this kind of fundamental framework of correspondent banking, and maybe it'll just die as we finish our project in about 5 years' time. Maybe not. So I'll just leave that with you, that cross-border payment system, it's really important. I think it is absolutely fascinating and can bear quite a lot more research in various areas. It's clearly a public good. It carries a public cost to all of us if it doesn't work well. And what is the future of the role of the public sector, therefore, in its governance and operations? Thank you very much. I think we're out of time, but I'm happy to take questions. Don't ask me which crypto to buy. That's the only thing. Yes. Maybe we should wait for the microphone. I'm sorry.
Thank you. Not a question, but rather a comment. I would strongly disagree with your statement that cryptocurrencies are not money, because if you go back to your definition, that is exactly, or many of these things is exactly true for many, many currencies in the world right now, like high price volatility, like it's not an investment vehicle because of the collapse of the currency. We've seen that in so many currencies of the world, take the Argentina peso, take the German mark in 100 years ago. Many of these things can well be said for currencies. And I'm not at all an advocate of digital currencies. However, I think excluding digital currencies as money is a big mistake, because they can be money. The question is, to me, why do we need them? Because I think, even though you describe the global payment systems as rather inefficient and too costly, however, the speed and the security of transactions is still far superior to anything that we've seen in the crypto world. So for me, I often ask myself, if a system which is in place now since, I think, 13 years when Bitcoin was first mined, has failed to solve a problem more efficiently than existing systems, I do not think it's worth all the hype and all the frenzy about it. So, thank you.
Okay, I like that challenge, and I think it is a point of debate. Our crypto money. I'm setting out my stall here. I don't think it has been yet. And maybe you're more optimistic that it will eventually acquire more of the characteristics of money. There is money that ceases to be money, and certainly we see the collapse of currencies quite frequently over history. So certainly the fact that they disappear doesn't mean that they don't exist. I don't think it's a store of value. I think it's a speculative instrument. I don't think it's used as a unit of account very widely at all. And it's only used as a unit of account so much that it is linked to a central bank currency. Celsius, I guess, it was kind of trying to have some kind of crypto bank aspect of financial intermediation or something. So maybe that is slightly different. But I'd still say crypto is not money. If you wanted to say yet, then that's okay. Why do we need them? Yeah, you have to ask the users that, maybe. I think a lot of people just want to see the price rise, and then they buy something when the price is rising. So purchases of crypto go up when the price is going up. So it doesn't seem a very rational type of exercise. There's been some studies done about who is buying and who is using crypto, and it's people under the age of 35, particularly men under the age of 35, which is a crossover with the gaming community and other sorts of things. So I think there's an element of that, and maybe that's the nature of a new technology and the way that it's disseminated throughout society. But I would say not yet, I guess, an answer. Why do we need them? Indeed. And I think we're seeing, particularly with the rise and the importance of Tether, or of stablecoins rather, that it's why would you use that instead of a central bank money or fiat money? You'd use it maybe because it's faster to settle, but that's not really taken off yet. And maybe because nobody can trace it back to you, and you can do it then carrying large amounts of cash. So cash is the other form, I guess, of money that doesn't have a ledger associated with it. So there is kind of questions, I think, about why you would need to do it through an anonymized distributed ledger rather than through central bank money. But remembering that there are frictions within the system. So it might be the opportunity cost in places like where the SWIFT messaging is very, very slow to settlement, I think it's greater.
Yeah, thank you for the great lecture. I just have a question, if you could say something more about what is the influence of multiple currencies in making this payment network that we have today slow, but also maybe resilient. And I'm asking this because, especially for cross-border payment, we have a project now with a professor here at Goethe, Barbara Brandl, and we are studying like the 80 projects that we have today on CBDCs. And most central banks in Africa, but especially Latin America, when they think about CBDC and cross-border payment, what holds them back is that they are fearing currency substitution, like when they move to CBDCs. And so is this a factor that could, how this features into our current payment system, and does it make it more resilient?
You can go in and the SWIFT messaging is divided by currency. So you can see the dominance of the US dollar in the denomination, I guess, of the messages that are underpinning the payments that are being made. And there's a bigger story about the network externalities and the reason for the dominance of the US dollar, despite the fact it loses value and gains value through inflations. And it maybe has to do with the depth and liquidity of their financial markets, although that changes over time also. And it may have to do with inertia. So I think that's part of a broader discussion about the role of the dollar. In sense of currency substitution, what is it going to be substituting for is one of the questions. So we've seen a real move away from cash, for example, and are we seeing maybe some movement in what is M0? Away from cash and towards maybe CBDCs. There's some risks that it will cause disintermediation and sideline commercial banks. So I think there's some issues to be resolved there as well. If you can have direct wallets at the central bank, why are you having a deposit account at a bank?
Thank you very much. I would like to come back to your conclusion, the last sentence with cross-border payment system, which is not a system in the way that the CPMI would define it, or the legal definition. But you say it clearly is a public good. Why is that so? I mean, you can be excluded, and banks have been excluded. Or do you mean financial stability is the public good behind it? I'm not so sure about your conclusion, actually. Thank you.
I think it has to do with financial stability, but also that it's a public good being able to buy something from somewhere else and make those payments. So in a sense, it's the ability of your populations to engage in this globalization. So maybe it depends on whether you think globalization is a good thing or a bad thing. But underpinning all those international transactions, international trade, international payments, and other kinds of international payments is the ability to move money across borders. So that's the kind of basic elements of what I see as something that's in the public good. Being provided by the private sector, which isn't necessarily a bad thing, and that's open for debate also. My ability to come here would not be possible unless we had a cross-border payment system, for example. Any other questions, or maybe we can draw it to a close, perhaps, on that rather depressing note. I think the future is bright, but the future may not be crypto, I guess, is the answer. But again, I'm a historian, and what I'm trying to say is we need to know a little bit more about how these systems originated, how they were debated, and why we have ended up where we are, whether you think it's good or bad. And that takes really detailed historical understanding of the institutional structures and the choices that were made over time, and not seeing it as an inevitable outcome of market forces. Thank you.
Catherine, if you allow, last question. Okay. From my side, as you talk about historical patterns that come up in that, if I see it right, I mean this analysis of transborder transaction networks is a very, very interesting topic in economic history, starting with Avner Greif's analysis of the famous Maghribi network, and your faculty colleague in Oxford, Sheila Ogilvy, is also very active in that debate with Greif. As I see, you find the same questions. I think, meaning that it's interesting to see that private institutions develop to answer apparent needs of the business people. And the question behind this is always, would that or can that develop without any public support? Or what minimum level of public support is necessary for keeping that private organization running? And I see also what you ask in the last on the last slide here, the last sentence. You are also looking for answering that question. What's the minimum of? Or would you say that there is a minimum of public legal structure necessary to keep that all running also in the future, or what would be the minimum public structure that is necessary?
Yes, I am inspired by these really long run ideas, and what those early frameworks are trying to understand is that time is risk, and to overcome risk, you need some trust and some way to institutionalize that trust, which requires some sanctions and some rules and this sort of thing. So I think that's kind of the fundamental idea about. And I'm very sold by Bill Getzman's idea about, finance is a time machine. It brings the money to you now that you should have later. So it's bringing the future to you through finance. I think it depends how it turns into a public good. Maybe is the breadth and public interest. There's the protection of the public role that changes over time. So maybe the protection of the public for the Maghrebi traders wasn't as great as it is now, when we're all perhaps more vulnerable to the failure of some of these systems because they've become so integral to our daily lives. So I think the nature of responsibility for these systems has changed over time according to the structures of the banking system and others. So in the 19th century, the traders would lose out, but there wasn't a lender of last resort, except they weren't going to be kind of bailed out by the taxpayer in that same kind of way that we saw in 2007-8, for example. So I think it's the evolution of the system that changes the public responsibilities.
Thank you very much. There are no further questions. Then I have the pleasure to thank you again for this wonderful lecture and also for answering the questions. Thanks to all of you who have come here and have participated in the discussion. And I wish you still some very interesting and intensive discussions with the researchers that come together here for that workshop, and then also very, very interesting and resultful days in Frankfurt.
Thank you very much. Thank you all.